Welcome to our deep dive on what to do if you receive a large lump sum just months before retirement. We will navigate the paradox between preserving capital now and ensuring growth for a decades-long retirement. As we begin, we will lay out the agenda and then move through immediate actions, risk protection, tax strategy, and long-term growth. Here is the roadmap for this video. We will start with the safety versus growth paradox, then immediate actions to take in the first 30 days. Next, we will cover the sequence of returns shield, inherited IRA strategy, the growth engine with equities, and a comparison of paying off debt versus investing. We will also discuss bonds in the current interest rate context, show sample allocations with diagrams, check understanding with quick quizzes, and finish with key takeaways and next steps. Now let us introduce the core paradox. The central paradox is this: your lump sum must support a retirement potentially lasting more than 20 years, parking everything in total safety risks, losing purchasing power to inflation. Going all in on risk exposes you to damaging drawdowns, especially early in retirement. Therefore, the solution requires a balanced framework that preserves near-term spending while maintaining long-term growth. With that context, we should start with a brief disclaimer to set appropriate expectations. This content is for education only, and not financial, tax, or legal advice. You should consult a fiduciary advisor and a qualified tax professional before taking action. The Secure Act and subsequent guidance introduced new inherited IRA rules, including a 10-year distribution window for most non-eligible beneficiaries, with additional complexities depending on whether the decedent died before or after their required beginning date. Rules can change, so verify with current IRS guidance. Additionally, market conditions and yields change. Use up-to-date information for your planning. With that in place, let us move to immediate actions. Receiving a large lump sum requires you to reassess your entire allocation. If your pensions and Social Security already cover approximately $30,000 of annual core expenses, the lump sum can take a measured level of market risk. Yet placing all funds in safe assets effectively guarantees losing ground to inflation over time. The key is aligning each dollar to a time horizon. Near-term needs in cash, mid-term needs in safer income instruments, and long-term needs in growth assets. Next, we will walk through a structured 30-day plan to rebuild your portfolio deliberately. In the first 30 days, begin with a full inventory of accounts and tax statuses. Determine how much of your annual spending is covered by pensions and Social Security. Build a 1 to 3 year cash buffer in highly liquid, ultra-safe vehicles such as high-yield savings, treasury bills, or government money market funds. Next, prioritize asset location. Hold bonds in tax-advantaged accounts and tax-efficient equity funds in taxable accounts. Construct a growth sleeve for dollars not needed for at least 5 years using diversified, low-cost, total market equity funds. Evaluate whether to pay off low-interest debt or invest, weighing both math and psychology. Consider building a TIPS ladder for inflation-adjusted cash flows and a short-term bond or CD ladder for safety. Finally, implement gradually and formalize rebalancing and withdrawal rules to reduce behavioral mistakes. Next, let us visualize the decision flow. This flowchart starts when the lump sum arrives. The first step is to assess expenses and guaranteed income sources. Then, build a cash buffer for 1 to 3 years of planned withdrawals. Next, allocate by time horizon. For near-term needs, use high-yield savings, treasury bills, or government money market funds. For midterm needs, consider a TIPS ladder or a short-term bond or CD ladder. For long-term needs, use low-cost, total market equities. If there is an inherited IRA, follow the 10-year distribution rule and prioritize required distributions while locating bonds inside tax-advantaged accounts. If there is low-interest debt, decide whether to invest for higher expected returns or pay off for peace of mind. Finally, set rules for rebalancing, withdrawals, and tax management. Now, let us zoom into the sequence of returns shield. Sequence of returns risk means that early negative market years can permanently impair a portfolio when withdrawals are occurring. To mitigate this, hold 1 to 3 years of planned withdrawals in high-yield savings, treasury bills, or government money market funds. This buffer reduces the need to sell stocks in a downturn. As an added benefit, treasury interest is generally exempt from state income tax, which can improve after-tax returns depending on your state. Next, we will compare common cash-like vehicles in a simple table. This table compares common cash-like vehicles. High-yield savings accounts have bank-determined variable yields, daily liquidity, and are subject to bank risk but insured by the FDIC up to limits. Treasury bills have market-based yields, high liquidity through the market, and are backed by the U.S. government, with interest generally exempt from state income tax. Government money market funds invest in very short-term government instruments, with daily liquidity and high credit quality, often with a significant portion of interest exempt from state tax. Short-term bond ETFs provide intraday liquidity, but introduce market price fluctuation and interest rate sensitivity. Certificates of deposit provide fixed terms and bank-level risk with potential early withdrawal penalties and state taxable interest. With the cash menu set, let us tackle inherited IRA strategy. Inherited IRAs often must be fully distributed within 10 years for most non-eligible designated beneficiaries. A practical approach is to prioritize spending from these required withdrawals, allowing taxable accounts to compound longer. Because bonds tend to be tax inefficient, they are often best located inside tax-advantaged accounts, including inherited IRAs when appropriate. Be aware that the exact required distribution timing can depend on whether the original owner had started required minimum distributions, and rules have been subject to evolving IRS guidance. Confirm specifics with a qualified tax professional. Next, we will visualize the 10-year window on a timeline. This timeline illustrates the 10-year distribution window that applies to many inherited IRAs. Year 0 is the inheritance date. Years 1 through 9 may involve optional or required distributions depending on regulations and the original owner's status, so professional guidance is important. By year 10, the account generally must be fully distributed for most non-eligible beneficiaries. Throughout this period, coordinate withdrawals with your broader tax plan, prioritize using these distributions to meet spending, and consider housing bonds in this account to improve tax efficiency. Now, let us check your understanding with a quick quiz. Quiz time. The question is, if you inherit an IRA and also have a large taxable lump sum, which source is generally most tax efficient to tap first for spending? The options are A. Sell taxable equities first. B. Spend from inherited IRA distributions first. C. Borrow on margin against equities. D. Cash out and buy long-term corporate bonds. You may pause the video now to consider your answer. We will discuss the solution in the next section. The correct answer is B. Spend from inherited IRA distributions first. Using required distributions to fund spending can reduce the risk of taking large taxable income later and allows the taxable account, especially if invested in tax-efficient equity funds, to compound longer. Now, let us focus on the long-term growth engine. For funds not needed for at least 5 years, equity exposure is crucial to combat inflation. Low-cost total market index funds offer broad diversification and tax efficiency in taxable accounts. Automate rebalancing and define withdrawal rules to reduce behavioral risk. During downturns, rely on the cash buffer rather than selling equities, which gives the portfolio time to recover. Next, we will visualize a sample high-level allocation using a pie chart. This pie chart shows one example of a high-level allocation. 15% in a cash buffer, 20% in a TIPS ladder for inflation-protected income, 15% in a short-term bond or CD ladder for stability, 45% in global total market equities for growth, and 5% reserved for opportunistic or other allocations. This is merely an illustration. Actual weights should reflect your risk tolerance, spending needs, and tax considerations. Now, let us compare paying off low-interest debt versus investing. On the left, paying off debt provides a guaranteed return equal to your interest rate, simplifies cash flow, and lowers the amount you must withdraw from investments, which can reduce sequence risk. It also offers psychological benefits. On the right, investing instead may provide higher expected long-run returns than a low-interest mortgage, preserves liquidity and flexibility, and can offer tax advantages when using tax-efficient funds. However, it requires emotional discipline through volatility. Many retirees choose a hybrid, pay down debt to a comfort level while keeping a meaningful growth allocation. Next, let us address bond choices in the current environment. In the current environment, locking the majority of your funds into long-duration bonds can create opportunity cost if interest rates change or inflation persists. A TIPS ladder can provide more reliable, inflation-adjusted income. A short-term bond, ETF, or CD ladder can deliver defined safety while allowing you to reinvest at changing rates. Maintain a substantial equity allocation to support long-term purchasing power, recognizing that retirement spans many years. Next, we will map asset location and cash flows with a mind map. This mind map centers on the portfolio. One branch is the cash buffer housed in high-yield savings, treasury bills, or government money market funds. Another branch is tax-advantaged accounts, including IRAs and inherited IRAs, where bonds and TIPS ladders often reside, and where required distributions can directly fund spending. The taxable branch focuses on total market equity funds that generate qualified dividends and potential capital gains harvesting opportunities. A separate branch highlights the debt decision, contrasting payoff with investing. The final branch sets rules for rebalancing bands, withdrawal policy, and tax coordination. Now let us do a quick knowledge check on the cash buffer. Here is another quick quiz. The question is, how long should your cash buffer typically cover to reduce sequence of returns risk? The options are A. 3 to 6 months, B. 1 to 3 years of planned withdrawals, C. 5 to 7 years of total spending, D. None. Stay fully invested. You may pause the video now to consider your answer. We will review the answer next. The correct answer is B. 1 to 3 years of planned withdrawals. This runway reduces the likelihood of selling equities at depressed prices during a downturn, while still leaving a substantial portion of the portfolio invested for growth. Next, let us consolidate the core points you can take away from this video. These are the key takeaways. Match assets to time horizons, use inherited IRA distributions first when appropriate, and prioritize bonds in tax-advantaged accounts. Maintain a 1 to 3 year cash buffer. Favor TIPS and short-term ladders instead of locking into long-duration bonds. Consider both mathematics and psychology in debt decisions, and automate rebalancing and withdrawals through documented rules. Now, we will summarize the plan in a concise markdown recap. Here is a concise recap using markdown structure. First, define how much of your spending is covered by pensions and Social Security, then size the gap. Build a 1 to 3 year cash buffer in safe, liquid vehicles. Use inherited IRA withdrawals first when possible, and place bonds in tax-advantaged accounts. Keep money needed beyond 5 years in low-cost total market equities. Prefer TIPS and short-term ladders instead of long-duration bonds. Finally, set explicit rules for rebalancing, withdrawal order, and tax coordination. To finish, let us wrap up with a summary and next steps. In summary, rebuild your allocation promptly after receiving a windfall. Protect 1 to 3 years of withdrawals in ultra-safe instruments. Coordinate taxes carefully, especially with inherited IRAs, asset location, and potential state tax benefits. Maintain a durable growth engine using broad, low-cost equities. Document your playbook and automate processes to remain disciplined through cycles. Finally, let us close with a thank you and a call to action. Thank you for watching. If this video helped you protect your capital today and plan for growth tomorrow, please like the video, share it with someone nearing retirement, and subscribe for more actionable planning content. What would your allocation look like, given your cash needs and risk tolerance? Share your thoughts and questions in the comments.